All right, good day. Today we'll be working on the earnings per share. We're dealing with IFRS 33, the earnings per share. With this earnings per share, we have two types: the basic earnings per share and the diluted earnings per share. We'll be starting off by looking at the types of shareholders. We have different types of shareholders where we have the ordinary shareholders who are deemed to be the owner of the company, and the other is the preference shareholder. Here I brought the 5 different types of preference shareholders. The shareholders we have them are the preference shareholders. With the preference shareholders, we have the redeemable preference shareholder, where the capital can be returned to the shareholder upon the fulfillment of a certain condition or period of time. The capital can be bought back to the shareholder in the same way like a debenture or a loan. We can pay it back in the same way like we pay back the loans. We have non-redeemable shareholder. That capital cannot be redeemed. It cannot be returned to the shareholder unless if the shareholder want to cease being a shareholder, he can sold it to someone else. All right, we also have another type, which is the cumulative, where the dividends in areas they accumulate. If for that certain year we haven't declared a dividend, it will just accumulate. But non-cumulative, if that year we didn't declare a dividend, it means there will be no dividend for that year. Participating are those preference shareholders who also participate in the remaining profit together with the ordinary shareholders. Remember, the preference shareholders, they get a fixed portion or a fixed dividends, but with the participating, they will also have a share in the remaining profits together with the ordinary shareholders. Right, let's move on with the basic earnings per share. The basic earnings per share, which simply means how much each ordinary share earns. One single ordinary share earns how much for that specific period. All right, let's move on. We are moving on to the basic earnings per share formula. This is the formula where earnings are divided by number of shares. Earnings divided by the number of shares. Okay, right, let's look at how we calculate the earnings or the basic earnings, which is the numerator in our formula. We will start off with that question one we have there, and they say a company has 10,000 ordinary shares and 10,000 non-redeemable 10% preference shares, and the preference dividends are discretionary and non-cumulative based on a deemed value of $2 per share. And they say the company earns a profit after tax of 100. Now we want to calculate the basic earnings, the earnings which belongs to the ordinary shareholders, and that we do it by taking that profit after tax for the year, we less the dividend that's distributable to the preference shareholders, which is calculated as the 10,000 we have here, this 10,000 multiplied by this 10% and multiplied by $2, we get the amount we have here, which is 2,000. we get the 2000 we have them, and then 100 minus 2000 we get this amount, and this is the amount that's distributable to the ordinary shareholders, and that's the amount that we will divide with the total number of shares, which is 10, and we get the answer here, which is 9.8, which means that for every ordinary share it earns $9.8. All right, next we are moving on with equity versus liability. Let's say a company has 10,000 ordinary shares and 10% preference shares in issue throughout 2021 with a deemed value of $2 each, and the 2021 profit after tax was 100,000. The required is to calculate the basic earnings in 2011, assuming that the preference shares are in A, non-redeemable, and dividends are discretionary and non-cumulative. There's a declared dividend. In B, they are still non-redeemable, and the dividend are discretionary and non-cumulative and is not declared. In C, they are non-redeemable and the dividends are discretionary and cumulative, and there was something that was declared. In D, they are redeemable and the dividends are mandatory and cumulative, and the dividends is declared. In E, redeemable and dividends are mandatory and cumulative. There's something there in D where the dividends are redeemable and the dividends are mandatory, which means that we are going to redeem them at the discretion of the investor. If it's at the discretion of the investor, this is just the same as when the bank say we give you this loan and at this certain time you will repay it, which means that this share capital in D it's deemed to be a liability. All right, let's move on to the scenario. So in A there was a declared dividend, and then in B there was nothing declared and it's a non-cumulative, which means that we don't have to account for here, and this one is not declared. All right, let's look at the answer. That's why you can see there's a profit then 100 in all the scenario, and then the dividend in A they were non-cumulative, however we have declared the dividend, they were dividend of 2,000. The same way as we have calculated the dividend in question number 1 is the same way we are going to calculate this one. And in B it was not declared, as you can see them. I know there is not declared, is 0 here. In C, so cumulative and is not declared. There's two important things here, being cumulative, not declared. Then this one brings us back there where we are saying that if it's cumulative, even if we haven't declared a dividend that certain period, it still has to be paid. Therefore we have a dividend in C. In D there is what I was explaining, the redeemable and it's mandatory, which is redeemed at the discretion of the investor. Then this means that it's a liability, and the dividend there which is declared it's part of the finance cost interest. It's regarded as interest because that one is regarded as a liability. Then it's already exclusive from the 100 because it's an interest, not a dividend. So we have 0 there. At E, they need a collection at E. I don't know why these people has put 0 here at E, because this is cumulative. It's cumulative, and these ones, we are repeating the same thing. Supposed to be non-mandatory here. It's non-mandatory and cumulative, because we are just repeating the same scenario. We're supposed to, in A, we're supposed to E, redeemable and dividends are non-mandatory and cumulative. So we're supposed to put 2000 here. Supposed to be non-mandatory so non-mandatory here, right? Okay, and it's supposed to have that's what it's supposed to have there. All right, and it's supposed to have 98 there. All right, that's how we have calculated the basic earnings in that question number 2. Let's move on to question number 3, where we have ordinary and participating preference shares. The company we have here has 10,000 ordinary shares and 10,000 non-redeemable 10% discretionary participating preference shares at $2 each. All right, the company earns a profit after tax of 100, and what they say next here, they say the preference shares participate to the extent of 1/4 of the dividends declared to the ordinary shareholders, which means that for the profits after we have deducted the preference dividends, the ordinary shareholders will take 4 portions, of which one portion will equivalent to the 4 portions gone to the ordinary shareholders, will be apportioned to the preference shareholders. And here they say the total ordinary dividend declared for 2021 was 4,000, and it said that the company declared the full 2021 dividends owing to the preference shareholders. All right, the question is calculate the basic earnings per share. Okay, we'll say profit for the year, which is 100, is given here. We are given that 100 here. We take the preference dividends, which is here, which is the preference dividend, which is 10,000 times 10% times $2. We get 2,000. We are having here, get this 2,000. All right, now then we get the earnings to be shared, and we have this statement which we say that they participate to the extent of 1/4. All right, which means now we'll come here, this stage will come there, and we will say if this is 98 and this one are participating 1/4 of the dividends that are declared to the ordinary shareholders, it means that they get the preference dividend, get 1 portion of the 98, and the ordinary shares get 4 portions of the 98. Therefore, we are going to say this 98 this 98 will say this 98 divided by 5 divided by 5. All right. If we take 98 divided by 5, we are going to get the 19,600 we are having here. And that will be the portion, is 1/4 we are talking about here. That's it. And if you take this 19,600 from 98, we get 78,400. That's 78,400. If you now take this amount, let's us name it A, and this one let's us name it B. If you say A over B, then we are getting this value. We are getting 0.25 if we do that. Okay, it means that these ones, the ordinary shareholders, they are taking 78,400. Now we will take that 78,400 divided by 10,000, which is what? Which is the ordinal shares, which is the ordinal shares we are having there, right? Okay, I hope you are getting that. Let's move first to the issue for value. Okay, all right. Here they say a company had 10,000 ordinary shares in issue during the 2000, and then on the 1st of April 2011, all right, then on the 1st of April 2021, that company has issued 12,000 shares at a market value of $5 per share. And then on the 1st of June 2011, there was a share split wherever 2 shares become 5 shares. And the basic earnings were 150,000 for 2020 and 261,250 for 2011. Required is to calculate the basic earnings per share for the years ended 31st December 2020 and 2011. There we have the column for details, the column for the actual number of shares, the column for weighted average number of shares for the current year, and the column for the prior year. The opening balance, as we can see there, we have 10,000 ordinary shares in issue during 2020. That's what we are talking about. That's the balance that we have, 10,000 here. In the weighted there is 10,000, and in the prior is 10,000 still. We have had an issue for value, which is the 12,000 that we have issued in the April, and in the weighted there is written 9. Why? What's the reason we write it as 9? We write it as 9 because it has only been in use for 9 months, because that capital has been brought in use on the 1st of April 2011. Sorry, if we count this month starting April to the 31st of December 2011, we will get 9 months. Therefore, in the weighted, we will say 12,000 times 9 months over 12 months, we are getting 9,000. And in the prior year, it's presented as 0. Why? It's because it has just been brought in use on the 1st of April during the current year, and it was not there in the prior year. All right. Then we get the total for the actual is 10 plus 12 is 22. For the weighted in the current year is 10,000 plus 9,000, we get 19,000 we have then. and we do the same for the prior year to get the 10,000. We have there in bold this 10,000. Now we have an issue for no value where we say on the 1st of June 2011 there was a share split where every 2 shares become 5. For every 2 shares we have in issue at that date, at that 1st of June 2011, it becomes 5 shares, which means that if you have 2 shares, you are getting 3 shares for free on top of that. And we were having 22,000 shares on the 1st of June. The balance we are having there in bold, this one. Okay, if you divide 22 by 2, we are getting 11. We are getting 11, which means the multiple of 2, because this share split is done in the multiple of 2, right? Which means that we get 11. That 11 is the one we are going to multiply with 3 shares, because we are getting 3 shares for every 2 shares. Okay, and that's where we get the 33 we have there. If you say 22 divided by 2, we get 11 times the 3 we get on top of every 2, we get 33 we are having there. And then now in the weighted we have 19. You can see that 19. To calculate the issue for no value underweighted, we are going to say 19,000 divided by 22,000, then we are getting the 28,000. I hope you can confirm that, right? Good. If you take 19 we have in bold there, divided by 22 we have in bold, times the 33, this one, let me highlight it, this, and this amount, we are getting this one. And same applies if you take this 10,000 divided by 22, the 10,000 divided by 22 times 33,000, we are getting is 15. Also, if you say 10 divided by 2, 10 divided by 2, we are getting 5. And if we are getting 5, we are getting 3 for every 2. 5 times 3, we just get the same answer, 15,000 we have here. Okay, the closing balance is given here. If you take this 22 plus this 33 we get on the share split, then we are going to get the 55 we have here. If we get this 19 plus this 28 500, we are going to get this 47 500 we have here. And then if you also take 10,000 we have here plus the issue for no value of 15,000, we will get the 25 we have here. Right, now that's the number of shares for the current year. Is called the weighted average number of shares. Now if you take the earnings for 2011, which is the current year, which is 250 divided by the 47 500 we have here, then you are getting 5.5. And then for the 2020, if you take this 150 being the earnings divided by the 25 being the total number of shares, then you get this amount. And then for the comparison, we can say in the prior year we performed better than in the current year, because here we earned $6, here we are earning 5.5. That's it. And something important here, there's something important here. This something is very important. That's very important, very important. It's very important that if there are more than one movement during the year, we have to handle it in chronological order. That's the same as we do, because the issue for value is the one come first in the 1st of April, is the one we do first, we get the balance, and then followed by the one split that has taken place in June. That's what we mean. Okay, let's move on. to the right issue. And the right issue, they normally call it a combination of full market price and bonus issue, and hence determine the weighted average number of shares involved. 4 steps. We'll be going on through this 4 steps. With that, question number 6 we have there, where they say in the year that was ended on the 31st of December 2019, there was 12 million shares in issue, and the earnings per share was calculated as 33.3 cents. And in the year ended 31st of December 2020, the earnings available for ordinary shareholders amounted to 5 million, and the company made a 1-for-5 right issue, which means you are getting 1 share for 5 shares on the 30th of June 2020 at a price of 1.5, and the market price was lastly known to be $2. You see, the market price is $2, but the light issue they did to say that if you are having 5 you get 1, you will get that one at 1.5, not at $2. That's where they say it's a combination of full market price and bonus issue. Okay, let's go through the steps that we have. Step number 1 is to calculate what is called the theoretical X-right price. They normally shorten it to say is TREP. Okay, with TREP we are saying that we have 5 at $2, that's 10, plus the 1 we get at 1.5, we get 1.5, and that is 11.5. We now have 6 at 11.5. Because if you are having 5 at, let me just mark it, you are having 5 at 2, which is 10, and you get to 1 at 1.5. Now you are having 6 at 11.5. We divide that 11.5, this 11.5 divided by 6. Where that 6 came from? 5 plus 1, we get 6. Where did 11.5 came from? 10 plus 1.5. If we divide, we get 1.92, and that's the TREP we are talking about. Step number 2 is to calculate the bonus fraction. With the bonus fraction, we take our market price before issue divided by TREP. This is TREP, and this is the market price. 2 divided by 1.92. Okay, that's the bonus fraction. Then they say determine the weighted average number of shares. We do have 5 columns: the column for date, the column for the total number, the column for the bonus fraction, the column for time, the time period the shares has been in use during that year, and we have the column for the weighted average number of shares. Okay, starting the 1st of January 2020 to the 30th of June 2020, we have been having 12 in issue. That's what we have here. This 12 is what we have been having until this date. Okay, and then we do have the bonus fraction here. The number of shares we have been working with, the number of shares we have been working with starting at the beginning of the year until the date of right issue, they are the one we multiply with the bonus fraction, which is 2/1.92, and then multiplied by time, that's 6. If you are moving from we are moving from the 1st of January 2020 up to the 30 of June 2020, that's 6 months we are having here. And then we are getting, if you say now 12 times 2 over 1.9, 2 times 6 over 12, we get this amount. And this one now, starting on the 1st of July 2020, we get 14, because we are saying if you are having 12 is divided by 5 multiplied by 1, because we are getting times 1. Then we are getting, if you do that, we will get 2.4. That's what we get, which means that at that date, if we take that 12 what we were having, 12, we'll get 14.4, and that's what we have here. 14.4 is what we are having here. In this one, 14.4, it will not be multiplied with the bonus fractions. It will only be multiplied with this time, because now we have 14.4 for 12 months. Then we are getting 7.2. The total weighted average number will now be 13. That's what we will use. We will say the profit for the year, which they say is what is it? Let's see. Which they say is 5 million. 5 million. Okay. 5 million, not 15. 5. Not 15 is 5. 5 divided by 13.4, we are getting this amount. 37.2 cents is the earnings per share. And for the purpose of comparison, they say restate the prior year's basic earnings per share. That one we multiply it with the inverse of the bonus fraction. If the bonus fraction is 2 over 1.92, the inverse is 1.92 divided by 2. That's what we will do, and it's what we have done here. We multiply it, we get 32 cents. Now we are able to compare to say this year we are better than the last year, because now we earn 37.2, here we earn 32. Okay, we move on to the diluted earnings per share, where they are working with conditional under a certain condition to say a certain condition has been fulfilled. Let us go on to say the following are the extract from Z Limited statement of comprehensive income for the year ended 2005. Profit after tax is 8,000. Income tax expenses is 390, and the profit for the year is 410. And there were 200 ordinary shares in issue at $2, and the company director holds 100,000 options. That's option, see, at a strike price of 2. Okay, and they say during 2015 the company shares had an average market value, the market value of 6. They say calculate the earnings per share figure for 2015 ascertained from the information given. The basic earnings will be the earnings we have, the profit after tax of 410 divided by 200 ordinary shares we are having. Then we will get 2.05. That's the basic earnings per share. Let's move on to the diluted earnings per share. How to compute the number of shares in the diluted earnings per share? The basic number of shares is the basic number of shares plus the notional exercise option. The basic we are talking about, this 200 we are having here, that's the basic. 200 is the basic there. We will add the notional and we will calculate the notional here. The notional is calculated as the total number of option, which is the 100 they have here, that the option, times their strike price, divided by the market price, because they will exercise the option at $2, but the market price is 6. If you say 100 times 2 divided by 6, we will get 33.33 shares, and this one will be sold. We assume that this one will be sold. If the market price is 6, this one will be sold. Okay, if this one will be sold, how much will be given away for free? We'll say 100 minus the 33,333, we will get 667, and this is the notional, is the one that is given away. The one that given away is the notional, and is the one that we will add to the 200 we have here as a basic, plus the notional. We get the diluted number of shares, which is 266,667. That's it. And then we'll say the profit for the year, this profit after tax divided by the notional number of shares, which is 266, diluted number of shares we calculated here. We will get this amount as the diluted number of shares. All right, thank you. We come to the ends of the earnings per share or IFRS 33 session. You are free to contact us. Our contact number is 081 560 8712. Thank you.